Welcome to the Deep Dive. We're your shortcut to understanding the big shifts in technology, and today we're asking a key question. In this world that's just changing so fast, who's actually laying the groundwork, the infrastructure for what comes next?
That's a critical question.
So our mission is to give you, our listener, a real insider's view on the future of connectivity. We're doing that by unpacking Nokia's latest Q2 2025 results and their whole strategic direction.
Yep, we've waded through the earnings call with the new CEO, Justin Hotard, and CFO, Marco Weyran, plus the full report.
Our goal is to pull out the really important stuff, the insights you need so you understand where this tech giant is going and why it actually matters to, well, pretty much everyone online.
That's right. We've done the heavy lifting so you don't have to. It's
Yeah.
not just about the spreadsheet numbers. It's about seeing how these big global trends hit a company that's right at the heart of it all.
And believe us, as we get into this, you'll see some maybe surprising strategy shifts and definitely get a clearer picture of the forces shaping how we'll all connect and innovate tomorrow. So let's dive in. Okay, so first look at Nokia's Q2 performance. It's kind of a mixed bag, wouldn't you say?
It is. The headline net sales were down 1%, but that's on their constant currency and portfolio basis. The reported number was actually up 2%.
Right. And that constant currency and portfolio basis, maybe quickly explain what that actually means for someone listening.
Sure. It's basically Nokia trying to show the core business performance without the static.
Yeah.
It takes out the effects of currency exchange rates changing and also any bits of the business they bought or sold.
So it's the apples to apples comparison.
Exactly. It gives you a cleaner view of the underlying health. So that slight dip there is worth noting, even if reported sales went up.
Got it. And their gross margin was stable, 44.7%. But the operating margin, the comparable one, that dipped down to 6.6%. And that dip, even with stable gross margin, suggests maybe costs are creaking up, or perhaps there are challenges in translating that top-line revenue into bottom-line profit efficiently. That's something a new CEO would definitely focus on.
Which leads us to the outlook change. They called it a prudent approach, lowering the full-year comparable operating profit forecast. It was EUR 1.9 to 2.4 billion. Now it's EUR 1.6 to 2.1 billion. What drove that?
Yeah, that's a significant adjustment. They pointed to two main external things. First, currencies, big impact there.
How big?
Well, the US dollar weakened quite a bit against the euro. They said the rate went from 1.04 in their original plan to 1.17 now. That alone chopped about EUR 230 million off their expected operating profit for the year.
Wow, 230 million just from the exchange rate.
Yeah. And interestingly, they mentioned EUR. 90 million of that was a non-cash hit related to their venture fund investments, valued in dollars.
Okay.
They even gave a sensitivity figure. For every single U.S. cent the euro moves against the dollar, it could change their operating profit by 10 to 15 million euros in 2025. That's incredibly sensitive, makes planning tricky.
Hugely. And the second factor was tariffs. They expect those to cost them about EUR 50 to 80 million over the full year.
So even if the core business is doing okay, these global economic factors, tariffs, currency, they really bite into the final numbers and the forecasts.
Precisely. It shows how exposed these global companies are.
But despite those headwinds, what about their cash situation? Were they burning through cash?
No, actually, they managed that well. They generated positive free cash flow in Q2 EUR 88 million. That brings the total for the first half of the year to over 800 million.
Pretty healthy.
Yeah, and they ended the quarter with a net cash balance of EUR 2.9 billion. So they have a solid financial cushion.
And they're returning some of that to shareholders too, right?
A dividend of EUR 0.04 per share for 2024 payable in August.
Okay, so managing the present challenges, but where's the growth coming from? Let's shift gears and get into the engine room of their business units. Network infrastructure, or NI, really seemed like the star performer.
Absolutely. And I saw strong growth, up 8% constant currency. That's where a lot of the positive story is right now.
Okay, we'll have to unpack this a bit. What's driving that 8%?
Several things. A big one is optical networks. That segment has really strong momentum, helped a lot by the Infinera acquisition they made.
Right, Infinera.
Their book-to-bill was well above 1, which, just means orders are coming in faster than they're shipping, a really good sign for future revenue.
And specific wins there.
Yeah, some big ones. They got their first award from a hyperscaler, one of the giant cloud companies, for these new 800 gig ZR/ZR plus pluggables.
Okay, 800 gig ZR/ZR plus pluggables. That sounds super technical, but why is that important for, you listening?
It's crucial. These aren't just alphabet soup, they're tiny components, but they handle massive amounts of data at incredibly high speeds. Think of them as the super-fast on-ramps and off-ramps for the data highways connecting AI data centers.
So getting a hyperscaler win means they're literally building parts of the AI backbone.
Exactly. They're right in the middle of that build-out. They also won a big deal with a major U.S. service provider. In fact, Nokia said growth in optical could have been over 10% if they hadn't hit some supply constraints.
Wow. And you mentioned hyperscalers now make up 5% of their total sales in Q2. That feels like a direct link to this whole AI supercycle everyone's talking about.
It absolutely is. And it's not just optical. Fixed networks within NI also grew strongly, up 17%.
17%. What's behind that?
A lot of it was fixed wireless access deployments, particularly in India. Plus, continuing strong demand for fiber from the big Tier 1 telecom operators. Nokia is also number one in OLTs. That's the gear in the phone company's building that connects your fiber line.
So connecting homes and businesses too. And IP networks.
Still very strong there. They're number one in edge routing, number two overall in routing. And this ties back to AI again. They mentioned they're part of bids for that huge EUR 20 billion EU program to build AI gigafactories.
So network infrastructure is definitely capitalizing on AI and general network upgrades. What about mobile networks? That seemed tougher this quarter.
It did. Sales were down 13% constant currency. But there's important context here.
Okay.
The main reason was actually how revenue was recognized last year. In Q2 2024, they had a EUR 150 million benefit from pulling revenue forward. So this year's Q2 looks weaker by comparison.
So it's a tough comparison year over year.
Exactly. And there was also some project timing stuff, particularly in India. The key message from Nokia is that for the full year, they still expect mobile network sales to be largely stable. So this Q2 dip isn't necessarily a trend.
That's really important context for listeners. Don't just look at one quarter in isolation.
Yeah.
And they did announce some wins, right? T-Mobile in the US, Elisa in Finland.
Optus in Australia, too. Yeah, solid deals still happening. And something else interesting in mobile is their growing focus on using Mobile Tech 3GPP standards for defense.
Defense, using Pi 5G tech.
Essentially, yes. Adapting the secure, high-speed wireless tech we use every day for military and national security needs. They partnered with a company called BlackNet and delivered specialized radio units to the U.S. Marine Corps.
That's a fascinating new market for them. Shows how strategic value might not always show up immediately in the quarterly numbers.
Precisely. It's about diversifying and finding high-value niches.
Okay, let's move to cloud and network services, CNS. That looked pretty good, 14% growth.
Yeah, CNS has good momentum. They're winning new 5G core deals, India, Europe, Middle East. The 5G core is like the brain of the 5G network.
Right.
And they're making real progress with their network as code platform. Think of it as opening up the network so developers can easily build new services on top of it using APIs.
Like an app store for network capabilities?
Kind of, yeah. Making the network programmable. They already have 57 partners signed up, including big names like Telstra and the Bridge Alliance over in Asia.
That feels like a significant shift towards software and services.
It absolutely is. And I also partnered with Verizon in the UK to deploy private 5G networks for businesses. It really shows that move to software and as a service models taking hold.
And briefly, Nokia Technologies, the licensing arm.
Steady growth there, 3%. Still expected to deliver about EUR 1.1 billion in operating profit for the whole year. They're expanding into new areas like automotive, IoT, consumer electronics.
Still a cash cow, that patent portfolio?
Definitely. And they just settled a patent dispute with Amazon, which helps clear the decks. It underlines the power of that IP.
Okay, so we've seen the different parts, the headwinds, the growth in NI, the context for mobile, the software shift in CNS, the steady IP income. Now let's talk leadership. Justin Hotard just finished his first full quarter as CEO. What were his big takeaways?
Well, he sounded quite optimistic, actually. More so, maybe. He really hammered home that connectivity is critical for the AI supercycle, not just for the usual suspects like cloud providers and telcos, but increasingly for defense and national security, too.
And he feels Nokia is well placed for that.
Uniquely positioned was his phrase. Because the value you get from AI fundamentally depends on the network underneath it.
That makes sense. He also talked about customers wanting to deal with Nokia as one integrated company. What does that mean in practice? That sounds like a big organizational shift.
It does. And he outlined some steps. They're unifying corporate functions. Think IT, HR, finance across the different business groups. The idea is to simplify how things work internally, build a more unified culture, and importantly, unlock operating leverage.
Operating leverage meaning become more efficient.
Basically, yeah, do more with less. essentially. Serve the whole company from a central function instead of having duplication. So as sales grow, profits grow faster because those central costs don't scale up as much.
And anything else on the customer front?
They're strengthening the role of executive account managers. So key customers should have one main senior contact point representing all of Nokia, rather than maybe dealing with different people from different product divisions.
A single point of contact, making it simpler for the customer.
Exactly.
Yeah.
It sounds like a move away from a more siloed structure. He emphasized predictability and continuous improvement as his focus.
It sounds like a clear signal of change from the top, adapting how they operate to meet those customer needs and market shifts. We'll definitely be watching for more details at their Capital Markets Day in November.
Yeah, that'll be the big reveal in New York on November 19th. Should be very interesting.
So to wrap up our deep dive today, we've looked at Nokia navigating some choppy waters, currency headwinds, tariffs impacting the outlook. But underneath that, there's real strength, particularly in network infrastructure, which is plugging directly into the AI build-out.
Optical and fixed networks showing good growth. Mobile networks had a tough comparison but looked stable for the year, and CNS is gaining momentum with software and programmability.
And all this is happening while new leadership is driving changes internally, aiming to be more integrated, more efficient, and more customer-focused as one Nokia.
That seems to be the core message.
So here's a final thought to leave you with. Think about that balance. Nokia needs deep, specialized tech innovation like those super advanced 800 gig optical parts. But they also need to present themselves and operate as one unified company for big customers.
The real tension.
Right. How does a company juggle being incredibly specialized in complex areas while also trying to be simple and integrated for the customer, especially in this fast-moving AI-driven world? Could that drive them forward, or could it potentially hold them back? Something to ponder. That's it for this deep dive. Thanks for joining us.